one of the things we talk about, oh, is the Fed going to hike rates or not? Well, rate hikes are priced in, right? And so, in that sense, I do think, and I don't think that there is an interest at the Fed to have a prolonged hiking cycle. And we have, well, as we're talking now, I'm looking here, we got a little less than two rate hikes priced in. But I don't think that's the end of the world for the price of gold, right? And if we can, and the fundamental backdrop that there's almost nobody in Congress that, and certainly no viable majority to institute entitlement reform. Those underlying drivers that support the space are still there. Caterpillar just announced its earnings, and they have a huge backlog, so that they produce mining equipment, and so you got to make sure that you have enough of that. But compared to other cycles, the cost pressures are not as severe as they have been. And then at $4,000 gold, these companies are amazingly profitable. And so the fact that they have gotten cheaper is to me attractive. The advantage of the juniors in general is that in a bull market, they have more upside potential. They're much more volatile, so the risk profile is different. Um, the major companies, they are so well managed that they have less leverage to the price of gold. So that doesn't mean they're not good companies. Definitely not. They are good companies, right? But it really depends on what one wants to have in one's portfolio and what the kind of the risk characteristics are of that portfolio that one envisions.
For disclosure purposes, our site does not make recommendations for purchases or sale of stocks, services, or products. Nothing on our site or this podcast should be construed as an offer or solicitation to buy or sell products or securities. All investing involves risk and possible losses. This podcast is for entertainment purposes only.
Axel, it's great to have you back on the show. As we just mentioned, a lot to unpack. I guess we'll start with the FOMC's talk on the 29th, keeping rates at the same rate, but still planning for that 2% inflation, which can you make sense of that for our listeners or for myself even?
So yeah, so let's unpack that a little bit, and I don't want to just repeat what you've probably heard from a bunch of other people. But if you think about it, historically, when, or at least in our memory, when you have a transition at the Federal Reserve, the goal is to have consistency, right? Let's have it as smooth as possible. And what is different about this time around is Kevin Warsh came in with an agenda of change. He is full of ideas, lots of it. And just for context, um, Jay Powell actually tried to pave the way. He said several things in the last months of his tenure that were more Warsh-esque, like, if that's a word, and so to try to make it a little bit smoother. And then Kevin Warsh, on his first meeting, he created all these task forces. And I think one of the key reasons he did that is you can't just storm in to a group of very strong-minded people and tell them we're going to change everything, right? It's not going to work. And so he had a lot of discipline there. I think what he did in the most recent meeting is he let several of his ideas slip through. And he thought he could handle the journalists. He's very smart, very eloquent. And he said, oh, I can deal with this. And so, but what happened in practice is that he went down a few rabbit holes and in doing so created uncertainty in the market. Let's just put it this way, right? The market didn't want to just hear, yep, we'll get to inflation down and believe me, and that's the end of it. They wanted to have a little bit more. And he gave them a little bit more, but some of it created volatility in the market. To answer your question, I believe, and I don't want to put words into Kevin Warsh's mouth, is a central bank can, of course, if they want to, get inflation to whatever level they want to almost overnight. But the disruption that would cause is just dramatic. And so it's part of the reason he talked about that there's a path to get there. But the way that people wanted to interpret it was obviously, oh, then maybe he isn't so serious to do it so quickly. I think we are putting a little bit too much weight on the details here. I think what we know is he wants the market to have a bigger say in the process. I think he's succeeding in that. But yes, you can't just manage things with words. But in the scheme of things, this was one meeting, and we'll move forward to the next one. And so I'm giving here a roundabout answer that of course there are inflationary pressures, and there's little the Fed can do about it, right? There's little they can do about the war in Iran and the like. What the central bank's role is, and I'm using here Kevin Warsh's words, is to make sure that the shocks that we have don't translate to other higher prices down the road, to the so-called second round effects, that there isn't going to be too much wage pressure or this or that. And the one concern I had, to just round it up with that, the best friend he seems to have right now is Madame Lagarde of the ECB. She spoke in Portugal the other day, and really not just defended but endorsed the approach of the committees and the like. And the reason I say that that's a concern is because philosophically the two are not aligned. But they've both been in the same shoe, that they are heading these organizations. And Kevin Warsh in particular has a bunch of people that don't want to see him succeed. And so um, I think he's staying the course, and he'll refine his message, and we'll have the same discussion going forward about, well, what's he going to do and what the like is going to do? Well, he controls the bazooka, and that's ultimately what matters.
With last time we talked energy prices, and we talked about that it was just factored in as a shock to the market. Obviously, the Iran war, we don't, no one knows when that's going to be really officially over. It's a never-ending story right now. Even if all these changes that he says he wants to accomplish, and even if he can get half of them done, do you think we could even get to that 2% place with the energy impact that's likely coming?
Central bankers like to say in the medium term. So not tomorrow. Keep in mind that when Volcker beat inflation, he didn't get inflation down to 2%. It was only in the Greenspan years that it came down there. What you can do is you can set the rate path to be in the right direction. And one of the things that I think Kevin Walsh should have said is he talked about that economists are too much focused on the right side hand of the decimal point. They should focus more on the left side. Now, he presumably didn't say it because he wouldn't be okay with 2.99%. But this is not a precise science. He wants to get on the right path, and clearly, when you have these shocks abound, then yeah, good luck getting to 2%. That's not going to happen in the short term. But to address what you mentioned at the outset, yes, last time we talked about, I said the market is pricing this in as a shock rather than structural change. I continue to believe that, or it's more that I believe it. That's what the data show. If you look at the forward curve in oil and the like, and uh, and so what that means is that as the bond prices moves, real rates have been moving because structurally inflation expectations haven't changed. And Kevin Walsh interpreted that as, hey, the market is doing its tightening, and that's somewhat correct. The way I like to look at it is that it means that if that shock abates, the real interest rates will come down again as well. And one of the things that I have said since we've talked about to others about is that what we're really looking for, I'm coming as a precious metals investor, I'm looking for that correlation between the price of gold and the price of oil to kind of to come down. Gold's correlation to just about anything is not stable. And the reason why the price of gold has been correlated to the price of oil is because both have been linked to the bond market. And and so if that correlation softens, and I think we have seen signs of that in recent weeks, that's a good thing. That means the price of gold is moving on, and it's, I think, part of the reason why in recent flare-ups, sure, the price of gold has reacted by far not as much as it had done several weeks ago.
We saw gold kind of stabilize and bounce back after the 29th when they said they're going to keep rates the same. Do you see any other short-term catalysts as far as for gold and the prices in that? I know you don't like doing price targets.
If a few things. The correlation breaking down, I think, is the most important one, which means gold can do its quote unquote own thing going again, more so. And that's not the perfect science, right? But it means that the other thing it means that the market is looking, even though I say it's a shock, they're kind of getting used to that shock, and the market is starting to focus on other things. We of course have we're recording this on Tuesday, the 4th of August. On Friday, we have the jobs report, and next week we have an inflation report. So by all means, those will be market moving, almost certainly. And the price of gold may well react to that, right? And then it comes back to, well, what's the Fed going to do with it? Well, the Fed is going to say, wait a second, there's another jobs report and inflation report coming out before the September meeting. And so we'll focus on that one. We have Jackson Hole coming up, the meeting of central bankers, where we will presumably the speaker lineup hasn't been announced yet, and it's not Kevin Warsh's show. It's the Kansas City Fed that organizes the event, but presumably he's going to speak there, and um, he has to think about how to use that, because obviously the market has told them we want to see more than speeches, but there's an opportunity to speak. Um, so I think that's a fantastic opportunity to set some ground rules about his philosophy, and so we'll see what he's going to do with it. But that's the sort of thing that will ultimately have an impact on the price of gold, because he is at heart a hawk, and the market hasn't quite taken that seriously yet. And so the question is whether he feels obliged to put his foot down on some things. Ultimately, I believe it when he says that he's data driven. The data is kind of mixed, and that's why the market is confused, because if you're not confused, you haven't paid attention. And he's just being honest in that.
What do you think would get the market to actually start believing him? Like once he starts
Well,
really
they,
putting
they
his foot
they
down?
are believing him. It's not that they're not believing him, but the volatility is just natural when you have a transition. You have a you've had three Fed chairs in a row that came from the same school of thought. And you have somebody who comes from a very different school of thought who is coming in with an agenda of change. The stunning thing would be if there were no volatility, right? It's not that the market doesn't believe him. What the market is trying to figure out what's the curve, right? When are we going to come in with hikes and the like? And there, I'm moving here on my screen because I'm just looking here. We currently, as we're speaking, we have a 58% chance of a rate hike in September, but maybe more relevant is what's the terminal rate at the end of December, and it's currently priced at 3.9%. Um, that's very similar and has been stable. So it's really the jigsawing that we have in between. The other thing that people have pointed out, well, what happens on the long end of the yield curve? What's happening with the borrowing cost? Um, is a multitude of factors, of course, that play into it. The potential for economic growth, right? As we're speaking, people are again euphoric about the markets, the growth market and AI and the like. The the other question is, well, the federal deficit, right? What's going to happen to that? And of course, yes, what the Federal Reserve is going to do is relevant. But if I look at a metric that I think is hugely important, and any gold bug out there will just roll their eyes, it's the 10-year real yield. So what is the expected yield in 10 years net of inflation? And any gold bug worth their salt will say, well, nobody knows what inflation will be over the 10 years. But the reason why I look at this metric anyway is because that is a confidence indicator. What does the market think? Can the Fed contain inflation? And it's currently at 2.4%, thereabouts. And that we get all excited when this thing moves by a basis point or five. And yes, it did move during this meeting because the market was trying to make sense of it. One of the things Kevin Warsh said in this meeting is he was asked, well, if 100% of the prediction, if the prediction market were to say there's a 100% chance of a rate hike, um, would you hike? And he gave the academic answer, which says it's only an input. Of course he would hike. But in his framework, in his frame of mind, it's only an input. because he thinks that he doesn't want to be, as he's saying, he doesn't want to be the referee shouldn't be driving the ball, right? It should be the players driving the ball. It should be the market driving the ball. So he's trying to teach the audience his way of thinking, but it came across as saying, yeah, if the market wants to hike, we may not hike. I don't think that is accurate, right? As a conclusion to draw, it was more meant as a philosophy how to relay it. And yes, that caused volatility because that's the challenge with speaking in a live audience. But I have no doubt that if that were the case, he would hike rates. And I don't think the market has any doubt. But the market is of course right to say, wait a second, what did you say here, right? And then everybody's piling in. Now, just for context, the reason I'm speaking positively about Warsh is because I think the ideas he has are tremendously important for the Fed. And as I've said before, the actual interest rate matters much less than a lot of the stuff behind the scenes. And you asked earlier, well, is he going to succeed with all these plans? Even if he doesn't succeed with any of them, but stops the slippery slope of veering ever more into politics with the actions that the Fed has done, we have success. So I see the glasses half full. That doesn't with the Kevin Warsh Fed. Uh, I get it that people can be critical of him, but I think it's in everybody's interest that he is successful, and so I continue to be rooting for him in that sense.
I want to switch gears to the bond market. Obviously, a lot of people have talked about Japan as the canary in the coal mine of what's, to come over here if we don't really get our act together. Do you think with Warsh in and some of the plans he has that kind of can help mitigate some of those possibilities coming down the road for us as well?
So the interesting thing about Japan is obviously that the U.S. facilitated or helped in the intervention in the yen. That's the first time since I think 99 that the US has done that. And so that obviously caught people's attention. Historically, intervening in the currency markets doesn't have much of an impact, has a short-term impact, but the currency gets on sale and then the speculators can pile back in. One of the things that came out yesterday is that Besant said, why don't we increase the swap lines that Japan has at the Federal Reserve to help Japan with its ideas of supporting its currency? And the background here is Japan is obviously the largest holders of US treasuries. And the question is, do they have to sell the treasuries in order to intervene in the markets? And if you're Scott Bessent, you may not like that because of the potential risk that that causes. But more importantly, um, if there were a swap line that you don't need to sell the treasuries, but could borrow against your treasuries, you can dramatically increase the firing power of the Bank of Japan. And my interpretation on that is that this is all about signaling. Why would Besant announce this? Why would, and by the way, the politicians don't like swap lines because saying, why are we giving loans to other things? Well, it's really just a technicality. So it's one of these things that from a political point of view, I just mentioned War should get out of politics and has the right plan. It might be difficult for him to say no if he gets that request from Treasury, but that's the sort of thing that pulls the Fed closer to politics because questions will come based on that. But from Besant's point of view, it makes a great deal of sense because by signaling that we have, or Japan has a much bigger bazooka than you thought that they have, it tells the speculators that, well, if you want to short the yen, do it on a small scale because we'll whack you. And so if he is successful with that signaling, then it serves its purpose. None of that fixes the long-term issues in Japan, right? Politicians are amazing can kickers to fix their problems, not just in the US, but in Japan. The Eurozone debt crisis showed it there too. And so I think we'll be talking about this many more times But yes, there's always a risk that something gets unhinged in Japan.
What are your thoughts on, like, everyone was quite optimistic about the bull market for gold and precious metals? Are you still feeling the same after all this volatility? Like, do you still think we have 2 or 3 years in the pipeline for that? Or like has your view changed on the precious metal sector, or are you more bullish now?
Well, more important than my view is where I put my money, and I've kept my money in this space. I am continue to be a substantial investor in both gold mining and in the precious metal space. We did have a double whammy earlier this year with the spike in volatility due to the Iran war and the rise in real yields that there were headwinds to the market. I love that that correlation has been breaking down, um, and that the market has been behaving much friendlier. The real yields are very high now, so they could come down. That I think even one of the things we talk about, oh, is the Fed going to hike rates or not? Well, rate hikes are priced in, right? And so in that sense, I do think, and I don't think that there is an interest at the Fed to have a prolonged hiking cycle. And we have, well, as we're talking now, I'm looking here, we got a little less than two rate hikes priced in. But I don't think that's the end of the world for the price of gold, right? And if we can, and the fundamental backdrop that there's almost nobody in Congress that, and certainly no viable majority to institute entitlement reform. Those underlying drivers that support the space are still there. On the expense side, they, what's normal is that when you have a boom, that you have a lot of cost pressure. Um, the stunning thing is that this time it is much less than in previous cycles. And yes, commodity prices are elevated, but we're not talking $120 ounce. We're talking oil prices much lower. There appears to be access to enough diesel. Clearly, it's not without risk. There are wage pressures, but they're not dramatic. There is Caterpillar just announced its earnings, and they have a huge backlog, so that they produce mining equipment, and so you got to make sure that you have enough of that. But compared to other cycles, the cost pressures are not as severe as they have been. And then at $4,000 gold, these companies are amazingly profitable, and so the fact that they have gotten cheaper is to me attractive. Now, needless to say, it's an extremely volatile space, and so it's not for the faint of heart. It's not for everybody, but I do think, and the one thing I may have said this last time we spoke, miners are competing with AI, and AI is also very capital intensive. And that's very different from what had been the case for almost 20 years, that mining was competing with software where the barrier to entry is very low. And so I think we have a much more level playing field. And and so I think it's there's a role for the miners to play in many people's portfolios.
With the whole AI, I mean, we've talked about lots of time on this show, and I think we talked about it with you as well, the AI bubble, speculation on that. Um, we have all these data centers that people are looking to build across North America, and when we see this whole energy prices and the war, what's the reality? Like, how much of that do you think is actually going to happen, I guess, in the future? And then how much do you think that will affect, again, the commodity space? Because so much of it has had to run based on this, factoring in that we need all this energy.
Well, there's a lot of money being spent, and because there's a lot of money being spent, the chip prices are going through the roof, and then companies are spending more money because otherwise it would be withdrawing things. So they'll do that as long as the market will feed that. Clearly, the credit default swaps of some of the big tech companies have gone up. In recent days, they've come down a tad. Um, this will work until it doesn't, right? I mean, a bubble is a bull market that you don't participate in. What some people have pointed out is that because there's a somewhat of a circular cycle here that feeds on itself, the revenues are going up, but on the expense side, for the folks selling chips, but if you build a data center, you amortize those expenses over several years. So the profitability looks high. Now that happens in any investment cycle, but just like everything here, it's very extreme. And so at some point the bust will come. I can't tell you whether that's tomorrow or in 5 years. I'd like to remind people that Greenspan warned about irrational exuberance in late 97 and it took until 2000. And so we know that there's a popular backlash. Um, so presumably the building is going to be more expensive, is slower. They're not going to build as much. Then the chips, they don't last forever, right? I mean, they do last, but the use you get out of these chips is much shorter than some of these amortization cycles. So the buildings will still be there. I do think that the trend overall is incredibly important, that we're moving more towards a true information age. Um, and it does need the physical infrastructure. We need to build out the grid. I mean, these are all very good problems to have, right? And I happen to prefer put my money in the miners that I think are comparatively cheap than in the big tech companies that are super highly and richly valued. But that doesn't mean that I'll make money and they don't. I mean, that's not how markets work, right? Markets exude the most frustration on investors possible. And it depends on, I'm somebody who is often early in taking my money out in a bull run, simply because I don't want to be there when the crash comes. But many people pursue the philosophy, you ride it out, right? What I do know is that this one is much more debt driven than it was in the late 90s when we had the tech boom. And so on the other side of that, there is going to be a lot more pressure on the Federal Reserve to ease when the bust comes. And we'll see how it plays out. I mean, that said, the underlying model of these tech companies is very profitable. So if they decide not to spend money anymore, they'll be cash flow positive again. So it's a very interesting world that we live in.
I definitely would agree. As far as with AI and gold, obviously China kind of feels like they're a little bit ahead of the game with every dip, they're buying more gold. As far as the energy infrastructure, they definitely are ahead. What do you think? What are your thoughts on that, like short term, long term for the US? And then I guess, do you think there's even any correlation to gold as that narrative moves ahead?
Well, China and the US are very different in business models, and they have the pros and cons. In an autocracy, if you're dedicated to a particular goal, it's easier to implement than in a democracy. But that doesn't mean they'll be better off. We have a lot of choices to make on how to regulate AI and the like. The problem with regulating any space is that the regulators don't really understand the space, and that's certainly true with AI. And so usually what happens is that the way I look at regulation and red tape is that it increases the barrier to entry, and then it causes unintended consequences. Now, we saw on some of the big hacks that were recently announced that the in order to defend themselves, the US companies needed to revert to open source models from China. There is a new micro industry building on open models in the US as well. They don't get much venture funding. I'm not concerned that there won't be enough competition. There will be a tremendous competition on the energy usage. We have to get better in using energy when we do all this computing power. And so yeah, China will compete on certain areas, right? They have a lot of well-educated people, but the US has tremendous advantages with the deep capital markets. The one we're not talking about is Europe. Europe is losing out on all this stuff. The only thing Europe is good at is red tape. And when you introduce red tape, as I just said, you increase the barrier to entry, which means you're rewarding the establishment. And in Europe, the established big tech companies are American companies. So Europe is shooting itself in the foot by hurting their own industry relative to the US. Obviously, US companies are not happy with some of the rules there, but still on a relative basis, the US companies are doing better in Europe than European companies. And the Chinese will do their thing. The one thing, of course, that has changed is that throughout the world, we have more interventionist policies on the government level for national security reasons, and that will have unintended consequences. Right? You can't micromanage a global economy, and so we'll see how that all plays out. Um, in the end, part of the reason the US is successful is because we got 50 different states with different regulations, and rigidly regulating stuff and regulating innovation away is very difficult. The reason the Soviet Union fell is because they were effective in imposing their regime. And it's part of the reason that China is doing all right, because they're also not that great in enforcing the rules. And that allows the human spirit to come through in various corners.
Do you think Canada is shooting themselves in the foot as well? Curious of that.
I don't understand everything that's happening up north. It's a um, Canada obviously has big potential. They have a lot of changes going on. They're very frustrated with the US because what any business person, and in that sense also government wants, they want clarity, right? And of course, the US has changed the rules of the game a lot, many times over. And uh, and so Canada still is the place to go for many mining companies because they have a well understood framework. And obviously, most of these mines are not necessarily in Canada. Um, I'm not going to get into Canadian politics. It's above my pay grade.
Fair enough. Um, for like before you were looking at developers, has anything changed with Warsh coming in or any of these catalysts? Has like, are you looking more at producers again, or are you going more risky on the explorers?
No big change in my attitude towards the space, and the there will always be opportunities. It's still the scarcest resource is good management, right? You got to figure out how to play it. The advantage of the juniors in general is that in a bull market, they have more upside potential. They're much more volatile, so the risk profile is different. Um, the major companies, they are so well managed that they have less leverage to the price of gold. So that doesn't mean they're not good companies. Definitely not. They are good companies, right? But it really depends on what one wants to have in one's portfolio and what the kind of the risk characteristics are of that portfolio that one envisions.
With gold, if there's no real correlation for its trading, what do you pay attention to? Like if some of the old technicals that people used to correlate with gold disappear, how do you follow that? Like what is
I well, I obviously I see the technicals. I don't like to talk about them much, simply because in my public face, I'm not a technician. I've actually studied a lot of technical analysis over the years, and I have some in my team that understand it as well. But I like, and part of the reason why it actually works for gold is because the fundamentals are actually quite simple compared to most other things, and that creates a following of technicians. Um, One of the main things I look at is the real interest rates in the long run, because at least as a theoretical framework, if the purchasing power of the dollar holds, why should you hold gold? And conversely, if that purchasing power erodes, gold can compete even net of storage costs. And then beyond that, I get a first-hand look as to the types of investors that are in the market just simply because of the work we do in-house, because of um, the product we have in the market. And so I get to see, is it speculators buying it? Is it diversifiers? Is it larger investors? Is it smaller investors? So I get a sense of that, of that's just a subjective interpretation of the health of the market. What of course don't see directly, but indirectly is about other central bank buying. And so I like to have that as a background. but I've never considered myself a day trader in precious metals. Um, Metals and miners can move quite substantially, and so I like to look at longer term trends. If we were to get into an environment where, well, let's take the higher for long environment, right? That's a hostile environment to the price of gold. I don't see that happening. Now, obviously, if we had a hawkish speech by Kevin Warsh, and there will be some over time, maybe in the not too distant future, that might in the short term be a headwind to gold. But as I indicated before, right, we got the rate hike priced in, and so um, I don't think that's going to make it or break it in the short term. I leave it to others to pass the words of every policymakers and have trading signals based on that. I monitor these speeches, but I'm really looking more for structural changes. And the only structural change there is, it's an important one, is that Kevin Warsh is now running the Fed. He needs to hurt the cats at the Fed, and that's going to take a while to get them aligned with his vision.
Do you know if there's more like of the generalist investor coming into gold now, or has this volatility scared them away temporarily?
The folks who are most fickle are the speculators. The speculators, they go to wherever the action is. And they used to be in the gold miners. Then they went to the meme stocks, to crypto and the like, SPACs. And then a year and a half ago or so, they came back into the space. They were scared out of that space when the Iran war started. They mostly add volatility. Um, and so the retail investor that is investing in fundamentals on the mining side, if anything, those have been growing of late. The long bear market that we had last decade really scared many away. And so they've been crawling out of their holes and been encouraged by what we have seen. And so we communicate a lot more with them. Maybe they just have more courage to speak up again. Um, but we have a lot of people. The other thing that's of course happening is that we have portfolio managers of generalist portfolios attend more meetings, earnings calls of mid-sized mining companies. So in that sense, there's a broadening of interest. And so that's something I'm watching to see whether we, what's happening because they have a lot of money and they can move markets. Um, None of this says that price of gold or miners are going to go up tomorrow, but I'm ultimately quite positively inclined towards that space at the current juncture.
What are your thoughts like as we come closer towards the midterms? Are you more positive for gold in the precious metals space, or do you think we'll have a couple more bumps in the road before then?
Well, of course, we'll have some bumps in the road because we'll see whether we get a rate hike or not. And either way, it's going to be a quote unquote bump. We will have the midterms, which presumably means gridlock in Congress, which means we'll see even more through executive action. Um, or we'll see more of a lame duck, probably a combination of that in Congress. And when you have gridlock, the way you get, I used to like gridlock, and then somebody pointed out to me that the way you have compromises, you just give everybody a gift. And I think that's what happens at the end of the day, that you spend even more money, right? Because you got to get things done. So there is nothing that I see fundamentally changing in terms of the big entitlement issues and the like. We might get excited about a tweak here and there, but we got to get the ship on the right path. If we can do it through growth, fantastic, right? Then gridlock means we're not going to have new regulations, but there's been a lot of talk about AI regulation, and if it's not this administration, the next administration is going to have much more. And they'll be egged on by both Democrats and Republicans because both sides seem to not like to have the local data centers and have noticed it's good politics to be against those data centers. Just as a reference point, right? If you want industrial growth, data centers are about the most environmentally friendly thing you can do. They're required to build their own um, energy production. But the reason why people aren't happy with it anyway, aside from the fact that it's fashionable, is that, of course, the transmission lines will also need to be expanded, and there will be a cost spillover for increased cost for the consumer. And surprise, surprise, consumers don't like it. So I don't blame them for that. But at the end of the day, economic growth requires more energy, and so it's good we're building out that. Whether we have a bust in between, well, then we have a better grid at the end of the day. So it's a what people the reason we have this popular backlash is because people feel like something is wrong, and they're blaming AI for it. I think the issues are far more fundamental, that and they're the consequence of the fiscal house not being in order at the federal level, because then we have the incentive to push prices higher, and people can't put their finger on it, and so they like to blame this or that. Doesn't mean there won't be a real impact when government intervenes in these things, but I think if we focus on the basics and let the market do its thing, we would be much better off.
If we get some kind of final conclusion to the war, do you think we'll have a bounce back in gold as well? If that happens short term soon?
That's an oxymoron. There is no such thing as final conclusion to just about anything. Keep in mind that, let's say I'm predicting an event and I'm 100% right on that. Well, the day we reach that event, the market will price in the next thing already, right? So the market will always be forward looking. I wouldn't be surprised is that what you see is what you get, right? There is no easy solution to what's happening around. So we'll have this back and forth of escalation, and then again, oh, we'll have a deal and we don't have a deal, and oh no, we can't trust them. Oh, everything is great. And so what you see is what you get. The price of oil is somewhat elevated, but there is enough oil there. In the meantime, we're investing in alternative avenues to get the oil out. The best way to get to a green economy is probably to have the war of Iran extend, because we are motivated to build more solar panels. So the market will find a solution. It's frustrating to be in the middle of it, and maybe we find some compromise. Geopolitically, of course, it matters a great deal whether Iran comes out strengthened or not, because if Iran comes out strengthened, China will be very motivated to do something in Taiwan. And so resolving this with Iran having the upper hand at the end of the day is not in the US interest. But this in between world that we live in right now, I would think Trump is quite okay with that, even if everybody else is very frustrated with it.
Axel, can you talk a little bit about Merck investments, and then um, what has been your strategy? Have you been, obviously this has been a buying opportunity. Are you doubling down on your portfolio that you were already in, or are you looking at new companies? Talk to us about the track record of this year.
So um, we manage a 2.5 billion physical gold product. We managed past tense until June 30th a mining fund that we grew from about 230 million to over 1.1 billion in 7 years. An activist investor has taken control of the board and pushed us out as of June 30th. I'm still an investor in that fund, but currently that fund is managed internally by an investment committee with no expertise in the mining sector. Um, you can Google that. I have a website where I talk about it and what's going to happen. But the easiest is if you sign up to my newsletters to be informed. But when you talk about track record, that was literally the best performing fund in the industry over the 7+ years, both in absolute terms as well as on a risk adjusted basis. And so very proud of that team. We're looking at new ideas, new strategies to pursue, and are welcoming investors to kind of express their interest in the next step we'll take on that in that journey. But for the time being, I continue actually to be invested in that fund and have my exposure through that. And I believe that portfolio appears to be coasting along for the time being. So it's a bit of an odd situation. So I haven't exactly redeployed that money, but we are working on a strategy to continue to serve those investors who prefer to be with us. Not you probably didn't expect that answer, but that's where we are on that.
Where can people sign up to find out more about your new adventure?
Yes, so merkinvestments.com is our website. We have a free newsletter there. Please sign up to be in the loop of what's happening. I'm on Twitter at Axel Merk is my handle. I comment there on what's happening at the Fed and the like. During central bank meetings, I tweet up a storm. Otherwise, I'm a little more reserved. But yeah, sign up for our free newsletter at merkinvestments.com.